You did it. You saved $500,000. Good job. That number represents years of hard work and saying no to things you probably wanted. It's a milestone that puts you in a completely different league. But hold on, because what I'm about to tell you is that the exact strategy that got you here, it's no longer enough. In fact, continuing with business as usual could cost you tens of thousands in taxes and misgrowth. In this video, I'll break down the new investment reality you're facing and the critical choices you need to make. This isn't about just getting by anymore. This is about making your money work for you in a way that's smart and powerful. The game has changed, and it's time for your strategy to change with it. Reaching your first $100,000 is an incredible feeling. You just save, put your money in a low-cost index fund, and watch it grow. That strategy is simple and effective, and it's what gets most people to the $500,000 mark. But here's the dangerous truth no one tells you. The game at $500,000 has new rules and new risks that smaller accounts just don't have. First, let's talk about concentration risk. When your portfolio was smaller, having a big chunk in that one tech stock that went to moon felt like a fast track to growth. At $500,000, that same concentration becomes a massive liability. A single downer in one sector can wipe out a huge portion of your net worth, setting your goals back by years. Diversification is no longer just a buzzword. It's an absolute necessity. Second, and this is the big one, you are now on the radar of the tax man. At this level, your investment gains, dividends, and interest can create a huge tax bill that just eats your returns. A 2% dividend yield on $50,000 is just $1,000. Not a huge headache. But on $500,000, that's $10,000 in income. Depending on your tax bracket, that creates a significant drag on your growth year after year. Without a plan for tax efficiency, you're just giving away money. Finally, the sheer scale of the numbers changes how you feel about risk. A 10% loss on a $50,000 portfolio is a $5,000 setback. It's painful, but you can recover. A 10% loss on a $500,000 portfolio is a staggering $50,000 loss. That's a kind of drop that can be emotionally devastating and tempt you into making a terrible, fear-driven decision like selling everything at the bottom. This is the inflection point. Your focus has to shift from just stacking money to strategic preservation and intelligent growth. To navigate this, you need to make 3 fundamental shifts in how you invest. The first shift is moving from a mindset of just collecting assets to one of strategic allocation. The simple approach of just buying an S&P 500 index fund needs to evolve. For a portfolio this size, you need a more resilient structure, and the one professionals use is the core satellite model. Think of it like this. Your portfolio is a solar system. At the center is your core, and orbiting it are your satellites. The core is the bulk of your portfolio. We're talking 70% to 90% of your assets. This is your foundation. The purpose of the core is not to shoot the lights out with crazy returns, but to provide steady, diversified growth that captures the market's long-term trend. The best assets for this are broad market, low-cost index funds or ETFs, a total stock market ETF, or maybe a mix of an S&P 500 fund and an international fund for global exposure. By anchoring your portfolio with this big, stable core, you're protecting the majority of your wealth. Surrounding this core are your satellite investments. This is the other 10% to 30% of your portfolio, and this is where you can take calculated risks to try and boost your returns. Your satellites are smaller, targeted bets. This could be individual stocks in sectors you really believe in like AI or biotech. It could be thematic ETFs focused on trends like robotics or cybersecurity. You might even put a satellite position into real estate through REITs or crowdfunding. The beauty of the core satellite model is that it gives you the best of both worlds. The stability of passive indexing with the flexibility to chase higher growth ideas. It puts a structure in place that stops you from throwing all your money at the hot stock of the month, while still giving you an outlet for your investment ideas. This is the first step to managing a $500,000 portfolio like a pro. The second crucial shift is evolving from just being a saver to being a tax-aware investor. At the $500,000 level, what you keep after taxes is just as important as what you earn. The key strategy here is asset location. Now, people confuse this with asset allocation all the time, but they are completely different. Asset allocation is what you invest in. Asset location is where you hold those investments to keep the tax man's hands out of your pockets. You have three basic kinds of accounts. Tax deferred, like a traditional 401k, tax exempt, like a Roth IRA, and your regular taxable brokerage account. Here's the rule of thumb. You put your most tax-inefficient assets into your tax-advantage accounts. What does that mean? It means investments that spit out taxable income every year, like corporate bonds paying interest or REITs that pay dividends taxed as ordinary income. By holding these inside a 401k or IRA, that income can grow and compound without you getting a tax bill every single year. Conversely, your most tax-efficient assets should go in your taxable accounts. These are things you plan to hold for the long term that don't generate much annual income, like broad market index funds. When you finally sell them years from now, you'll pay the much lower long-term capital gains tax rate. Another powerful tool is tax loss harvesting. This is just strategically selling investments that have lost value. You take that loss and use it to offset the gains from your winners, which lowers your tax bill. This isn't tax evasion. It's smart, legal tax optimization that can add tens, if not hundreds, of thousands of dollars to your net worth over time. The final shift is about redefining how you think about risk. With a $500,000 portfolio, it's no longer a simple choice between safe and risky. It's about building a diversified engine for growth that can handle a few shocks. This is where you combine your strategic allocation with your personal situation. If you have decades until retirement, an aggressive growth portfolio might be 70% in stock ETFs, 10% in higher risk alternatives like private real estate, 10% in bonds, and 10% in cash. But if you're getting close to retirement, you might want something more conservative, like 50% stocks, 40% in fixed income like bonds to provide stability in income, and 10% in cash. Let's make this concrete. A core holding in an S&P 500 index fund has historically average returns of around 10% annually over the long term. For diversification, you might add a 10 to 20% allocation to real estate. This could be through REITs. Now, while their dividend yields are off in the 3 to 4% range, their total historical returns, including appreciation, have often been much higher, closer to 8 to 12%. For stability, fixed income like bonds or even high-yield savings accounts are currently offering yields around 4 to 5%, providing a low-risk source of income. The key is to avoid putting all your eggs in one basket. Even if you love real estate, putting all $500,000 into one or two properties is a huge risk. The same goes for being all in on stocks. And at this level, you absolutely must have a robust emergency fund with 6 to 12 months of living expenses. This is not part of your investment portfolio. It's a financial firewall. It's the money that keeps you from ever being forced to sell your long-term investments at the worst possible time just to cover an emergency. Hitting the $500,000 mark is a testament to your hard work. That's a fact. But it is also a critical inflection point that demands a new strategy. The simple brute force saving and basic investing that got you here are no longer enough to get you to the next level, whether that $1 million or full financial independence. By making these three shifts, from simple saving to a core satellite strategy, from ignoring taxes to tax-efficient structuring, and from a simple view of risk to a resilient, diversified engine, you are taking control. You are moving from being just a saver to becoming a true investor and the manager of your own wealth. This is your new investment reality. Embrace it, and you will not only protect what you've built, but grow it beyond what you ever thought possible.